Have you ever wondered what would happen if you saved just $100 every month? Most people think that's too little to make any real difference. But what if I told you that one simple decision could change your financial future forever? Today, we're following two friends. Both earn the same income. Both decide to set aside $100 every single month for the next 20 years. But there's one important difference. The first friend saves every dollar in a traditional savings account. It feels safe. There's almost no risk. The money is always there whenever it's needed. The second friend makes a different choice. Instead of letting the money sit in the bank, they invest the same $100 every month into a low-cost index fund. No fancy stock picking, no gambling, just consistent investing month after month. At first, the difference is almost impossible to notice. After the first month, both have $100. After 1 year, both have contributed $1,200. It looks like they're making exactly the same progress. So why would anyone choose investing? Here's where time changes everything. Saving protects your money. Investing gives your money the chance to grow. And the longer you stay invested, the more powerful that growth becomes. This is called compound growth. It's one of the most powerful financial principles in history. Your money doesn't just earn returns, those returns begin earning returns too. It's like planting a tiny seed that slowly grows into a huge tree. The beginning feels slow. Sometimes it even feels like nothing is happening. But over time, that tiny seed becomes something much bigger than most people ever imagine. Now let's see what happens after 5 years. 5 years have now passed. Both friends have stayed disciplined. Neither missed a single monthly contribution. Each has invested a total of $6,000. At first glance, it still feels like they're in the same position. The saver opens the bank account and smiles. The balance is exactly what they expected. Every dollar is safe. There are no surprises, no market crashes, no sleepless nights. But there's also very little growth. The money has barely increased because savings accounts are designed to protect wealth, not multiply it. The investor has experienced something completely different. Some years the market moved higher, other years it dropped sharply. There were moments when the portfolio lost value, making it tempting to stop investing altogether. But instead of panicking, they kept investing the same $100 every month. Whether prices were high or low, the habit never changed. This is where most people fail. They invest when everyone feels optimistic and stop investing when fear takes over. But successful investors do the exact opposite. They stay consistent. After 5 years, something interesting begins to happen. The investment account starts growing faster than the monthly contributions alone. The gains from previous years begin generating new gains. Money starts working for money. This is the true power of compounding. It doesn't feel exciting in the beginning, but once it starts accelerating, the difference becomes impossible to ignore. And the next 5 years will completely change the outcome. 10 years have now passed. Both friends are still investing the exact same $100 every month. Neither became rich overnight. Neither won the lottery. The only difference is the decision they made 10 years ago. The saver feels secure. Every dollar is protected inside the bank. But inflation has quietly been working against them the entire time. The cost of groceries has increased. Rent is higher, cars cost more, even everyday essentials are more expensive than they were a decade ago. The money is still there, but its purchasing power isn't. The investor has also experienced difficult moments. There were market crashes, negative headlines, economic uncertainty, and plenty of reasons to quit. But instead of reacting to fear, they continued investing every single month. During market downturns, those same $100 actually bought more shares at lower prices without realizing it. Every crash became an opportunity. By year 10, the gap is no longer small. The investment portfolio has grown far beyond the total amount contributed. Compound growth is now doing most of the heavy lifting. The monthly deposits are still important, but the investment returns have become even larger. This is the moment where patience starts paying off. Not because the investor was smarter, not because they predicted the market, but because they stayed consistent when most people would have given up. And over the next 10 years, that small $100 habit transforms into something far bigger than almost anyone 20 years have passed. Both friends stayed committed to their plan. Neither tried to get rich overnight, neither chased the latest investment trend. They simply stayed consistent. The saver looks at the bank account. There is a solid amount of money waiting there. It feels safe. It always did. But after 20 years of inflation, that money doesn't buy what it once could. Its value has quietly been reduced over time. The investor opens the portfolio. What started as $100 a month has grown into something remarkable. Not because every year was perfect, not because the market only went up, but because time multiplied every consistent investment. That's the difference between saving and investing. Saving protects your money. Investing gives your money the opportunity to grow faster than inflation over the long term. Of course, investing comes with risk. Markets rise, markets fall, nothing is guaranteed. But history has shown that patient, disciplined investors have often been rewarded over long periods of time. The biggest lesson isn't that saving is bad, and it isn't that investing is always better. The real lesson is understanding the purpose of each. Save money for emergencies, unexpected expenses, and short-term goals. Invest money for your future, retirement, and long-term wealth. The people who build lasting wealth usually don't rely on one strategy. They know when to save and when to invest. So if you had an extra $100 every month, what would you do? Would you keep it safely in a savings account or let time and compound growth work in your favor? Tell us your answer in the comments. And if you enjoy simple animated finance stories that make money easier to understand, subscribe and join us for the next lesson.